Hey everyone, welcome back to Yuri's Box. Today I'm gonna give a kind of roundup of the past week when it comes down to everybody's most hated asset in 2025, TLT. If you like this kind of content, consider leaving a like. And anything, I'll say it now, so I'll have to say it 1,000 times during the video. Anything that's said in this video shouldn't be considered financial advice. So it's been kind of a roller coaster week when it comes to price action in TLT. Basically, the short version of it is nothing happened. Okay, we had a scare in on Wednesday with a hot CPI print, but that got quickly unwound on Thursday and further pushed down, clamped down on Friday with the retail sales release. So basically, if you missed it, basically CPI comes out and it's super hot. The next day, PPI comes out and it's hot. But the way market interpreted it is that basically the components that go into form PPI suggest that there will be a bigger drop in PCE in 2 weeks, as this article by Mortgage Nerdy Dudes indicates. And what basically PCI is another way of measuring inflation. It's the Fed's preferred measure, actually. So it was kind of a situation where, yeah, we have bad news, but let's look through it. Let's look on the other side. And then on Friday, retail sales came in particularly low, particularly weak. Now, the important caveat on both CPI and retail sales is that we had revisions where on the CPI side, CPI on the previous months came in lower, so better, and it actually pushed up the month-on-month reading. Same thing happened with retail sales. Retail sales were revised up the previous months, so the month-on-month actually looked worse in January. So take that as it is. Now, looking forward, I think it pays to answer the question, where are we going? And insofar as where we are, where are we right now? I answered most of that question, I would say, in the first video. And just to give a brief summary, I basically argued that job quits are a great indication of what people are doing. And what people are doing in the labor market is really the way you should see, the way you should interpret the fears of inflation coming back. And why is that? Because let's put this back up. So I pointed out this nice correlation between job quits and the inflation rate. The headline inflation rate. So, and the argument, again, to cut things short, is that whenever we are at cycle highs in the job quits, that basically means that people are confident enough that they can switch jobs and get a better salary. And even if they don't switch jobs, the fact that they can switch job implies that they can go to their current employer and ask for a raise. So high quits number feeds into compensation. Compensation feeds into consumption. And that just acts like a bidding up of consumer prices. The opposite is true when job quits are lows. Lower job quits, lower compensation rate, wage compensation, and therefore a lower pressure, generally speaking, on inflation. Okay. Now, looking back at what generally happens throughout the September to March timeframe. So late Q3, um, mid Q1, let's call it, end of Q1. We basically have what I called a bump in inflation. Okay, so let's say around November. Okay, October, November. Let's call it like this. If I can, yep, here we are. Why isn't this showing up? All right. Anyway, let's say November again. November. That was weird. And looking forward, we have in 2023, as an example, we've had inflation act quite sticky, where it only peaked out in March at 3.5. Arguably, we find ourselves in the same situation this year. September comes around, Q3, and ever since, we've been on an uptrend in inflation. Now, I also said that what makes this year particular when compared to last year is that we've had a variety of factors kind of influencing and making actually the inflation narrative more worrisome, like natural disasters, say the fires in the wildfires in January, the fear of the threat rather of port strikes in September, hurricanes in October, and the ongoing tariff fears, which have all fit into the inflation story, the inflation narrative. Now, as I also said, this bump, as I call it, usually fizzles out at the end of Q1, beginning of Q2. And that actually leads me nicely onto the second part of this video, which is labor market conditions. So elaborating further, going past the quits rate, what can we extrapolate from the data we have? So I look at, say, a few things. And one thing we can look at is initial jobless claims. Okay. Let's hide inflation. Okay. So in white, you have, I'll just get rid of these. So in white, what you basically have, I put this back to the weekly. So again, in white, you have Q1. Okay, so what do you see in Q1? You see jobless claims bottom out, and this is looking at the beginning of last year. You have jobless claims bottoming out after having been on a significant uptrend, okay, the past year, topping in the summer, resuming a downtrend, bottoming in January, and after that, you actually see jobless claims slowly grind higher. Now, my base case is that we are about to flip from the inflation narrative to the growth narrative. And I think jobless claims will be one place to look for that, for confirmation. So if you actually do see jobless claims repeat what we've been doing for the past 2 years or so, that would be kind of your green light. Now, what could definitely feed into jobless claims going higher is also what Doge has been doing, which has been quite interesting, given that really nobody would have bet a cent on any degree of success of famous Department of Government Efficiency. Um, I don't really put too much faith in it because I realize that it's an enormous task and it could just stop tomorrow. All I'll say is that whatever comes out of Doge will be a massive tailwind. Will be I'll take massive out of the equation. It'll certainly be a tailwind to the shift in narrative that I'm foreseeing. Um, and just to add something else up on that, the way you should interpret government layoffs, as far as I'm concerned, or at least the way I'm interpreting anyway, isn't so much in the gaze of initial jobless claims ticking up. That is definitely something that can get affected. Non-farm payrolls can definitely get affected, but the biggest consequence of layoffs in the government sector is that is the opposite of it's, let's call it, reverse stimulus. So a salary that gets cut is in essence cash that isn't flowing through the economy anymore. Okay, and that's really the way you have to see it. It's, again, reverse stimulus. That is the best way to interpret that. Okay, so keep an eye on what Doge is doing. Again, if the trend continues, that can definitely be a tailwind to everything that I'm saying here. Another thing we can look at is actually the unemployment rate, which is directly correlated to initial jobless claims. And so basically, you see the exact same thing happening here in the unemployment rate. Okay, let's go back to 2022. You have unemployment at cycle lows. The last time it bottoms is April. It begins an uptrend. It tops in the summer. Then you basically have sideways action until March of the following year. An uptrend going into the summer. Sideways action. My base case, again, as I said with initial claims, is that we are likely to see, there's a chance that we will be around this area here, 4.3 to 4.6. And that's as far as I'll push it. I'm definitely not going to paint, apocalyptic scenarios or anything. It just seems as consistent with what the cycle has been so far. So it's definitely something to keep an eye on. Another way you could visualize all of this is going back to my previous video, is that you could also argue that a lot of the excess of this cycle has been wrung out. Okay, if job quits are an indication, I don't know why this isn't loading up. Okay, here we go. If job quits are an indication, okay, and people are telling you through their actions that things are definitely not as accommodative in the labor market as they were, say, a year and a half ago, or even a year ago. And also, this is maybe a bit more flaky, but you could also just look at the Fed's balance sheet and, like, say this initial impulse was the response to the pandemic, and everything that followed from that, this phase here, was kind of the excess. You could argue that right now we are well below it. And any further cooling from now on could definitely have a more negative effect than what has happened up until up until now. Um, and then we really have to see what happens during the summer. And I'll go over what I see as consensus, especially when Trump got elected. One of the prevailing ideas was that if we were to see pain, it would likely come in Q1, in the first half, sorry, of 2025. I tend to disagree with that. And and again, that is a very big if, there is to be any pain, it would likely come in the second half of 2025. Now, why do I think that? So, we went over the fact that you have an effort, at least, to reduce the government workforce, and as I said, that's really reverse stimulus, where you have basically less salaries chasing things, less money flowing through the economy. But that takes time. It takes time to have an effect on things. It doesn't happen from in a week's notice. So whatever happens now, you really have to think at least 6 to 9 months in the future. Okay. Another thing that gets thrown out there are tariffs, which actually leads me back to inflation and why it could actually be a tailwind for further disinflation. So the way I see tariffs, and again, this is very debatable. You can find people that are on the complete total opposite side that I take, and that's fine. But the way I see tariffs is a form of inflationary deflation, if that makes any sense. And the reason for that is that it really depends when this sort of policy gets enacted. Because going back to our trusty quits rate and inflation correlation, what allows for a massive rise in inflation is the fact that people have the propensity to spend. Okay, so if they have the propensity to spend, it's because they have wages going up. We don't really have that now. And what I'm arguing is that we're actually at the opposite side of that. And what that means is that people are in a more precarious situation than they were, again, even a year ago. And any potential price increase could lead to the opposite, to the most counterintuitive consequence. So let me give you an example. Let's say oil. Okay, let's take oil for example. Let's say oil just does something insane. Let's just say it goes up to, I won't even bother changing the chart. Let's say it goes back up to $120. Okay. Now, would that push up CPI? Oh, you bet. Okay, there's no doubt about that. But given how stretched, potentially, people are right now at the moment, it is more likely that the answer to that inflation is, I can't do it anymore. It's impossible for me to keep up. And so what you actually have is demand destruction because of that. Okay, so that's how I think about tariffs. Inflation in the short run, but given where we are, unless we have, again, massive stimulus, which again would be the enemy of being having a positive outlook on TLT, unless barring that, of course, as far as I'm concerned, tariffs are a headwind to growth, a further headwind to growth. So really, going into the summer, I think it'll pay to to keep an eye on the unemployment rate, um, for that shift in kind of worries in the market. Because again, going back to TLT chart, I would argue that this downtrend over here that we've had ever since September is kind of the photocopy of the downtrend that happened at the end of December up until April, where we had that kind of inflation is sticky scare. Okay, it got pulled forward due to the holiday season, of course, but also tariff fears, and natural disasters. And going forward, given everything that I've said about the conditions in the labor market, I would expect bonds to kind of loosen up as we rotate out of the inflation theme and go back to what is actually growth doing. Because again, as I said even in the first video, the consensus right now is that it's probably a bit too positive on growth and a bit too pessimistic on inflation. I think there is reason to believe, at least I believe it, that it is actually the opposite. That growth isn't as strong as people suspect, and that inflation is much less of a problem um, as people think. Now, having said that, next week and in the following weeks, we really don't have much of catalysts to move price in a direction or the other. Next week, you do have housing data. I mean, if it comes in really good or really bad, of course, it can move the price, but I'm not really. I won't have my eyes stuck at the computer looking for dramatic moves. I think that until ISM data comes out, which I think is February 23rd, the week of February 23rd, um, I could very well see TLT go back down to the $85 range. Anything is possible. It could also have something really negative come out and just sweep the low, as I discussed, which is something that, if you, in the context of history, you either have a lower low or a higher low. So I really don't know what it'll do in the short run. Directionally, though, looking towards the summer, I suspect that the narrative will flip from basically we're gonna be in the 1970s again to really having to reassess the strength of the U.S. economy. So to sum things up, keep an eye on the unemployment rate, both for government layoffs and just what history has taught us so far. Of course, feeding into that goes initial jobless claims. Okay, so we have actually bottomed out, okay, in January this year and last year, with a general uptrend going into the summer. Keep an eye on quits and let inflation kind of do its own thing. I think looking at how things are evolving on the labor side, actually, you can also look at capacity utilization. Okay, it's kind of at a curious spot as well. It's definitely cooled off, but it doesn't indicate that like the economy is at 2021 or 2022 trajectories. Another thing you can look at is weekly average weekly hours, I think it is. No, average weekly. Here we are. Average weekly hours. We are at 34.1. Yeah, there I got it. This actually leads unemployment. So keep an eye on all these small indicators, because I think they'll all feed into each other as we get closer to the summer. And yeah, I guess I'll leave it at that. If you enjoyed the video, consider leaving a like again, and I'll see you next time. Bye.